What would you do if you couldn't go to work tomorrow for the next year, the next 5 years, or if you could never go to work ever again? Hi everyone, thanks for joining me today. My name's Jessie McCormack from Evergreen Financial Advisors, and I want to discuss something today that I'm actually pretty passionate about, and it doesn't sound very exciting, but it's life insurance. And I really want you to think about protecting yourself and your family, and if you have kids, financially, if anything were to happen to you. Now, there's a few different types of life insurance. The first one is life insurance, obviously. You have total and permanent disability insurance, sometimes abbreviated to TPD insurance. You also have income protection insurance, and the last one is trauma insurance. The most common one is life insurance. So if you were to pass away, a lump sum payment would be paid to whoever you nominate, and that can be used to square away any debts like a home loan or a credit card, just to make sure that doesn't fall on any of your family members. It can also be used for expenses for your family. For example, if you had a child that was a teenager, you could say, if something were to happen to you, I want about $50,000 per year until the child turns 25 to cover their expenses. I want to pay for their university. I want enough money in my life insurance to cover the cost of their first car. So that's a bit about life insurance. TPD, or total permanent disability insurance, is when you can never work again. So you would get a lump sum payment from whoever you have TPD insurance with, and commonly it's used to pay off any debts such as home loan debt, credit card debt, and it's meant to cover your expenses for the rest of your life. So if you're 30 and you can never work again, you get this lump sum and it covers your expenses, maybe $50,000 a year, from now until they're maybe 95, which is the average life expectancy. Income protection insurance is a really great one if you're temporarily unable to work. To give you an example, if you were at the gym and you hurt your wrist and you were unable to move it, maybe you needed 6 months to recover. If you were in a position where you're in the medical field, maybe a doctor or a physio or a nurse, and you need your hands to complete the tasks of your job and you're unable to, you can go ahead and claim income protection insurance, which would cover 70% of your salary. So you don't need to worry about those financial aspects when you're trying to recover. It would cover, essentially your salary. So it's covering off your home loan repayments, groceries, kids' education, stuff like that. So you don't need to worry financially at that point. If you think about if you were to, horrible topic, I'm sorry guys, but if you were to get cancer, what would happen financially for you at that point? Well, you might have some sudden medical costs that you need to cover for any chemo or stuff like that. You would, if you're in Townsville like me, maybe you'd need to go to Brisbane to get that treatment. So that might involve stopping or reducing work hours. How do you kind of cover those costs? It might be $50,000 of medical costs. How do you cover your home loan repayments, groceries, stuff like that in the short term when you're dealing with all this, which is already a huge mental load? Income's trauma insurance, it would pay you out a lump sum to cover those medical costs and maybe some of those reduction in working hours, just so you're not out of pocket or stressing about money during that time. I want to give you guys some facts on life insurance. So only half of Australians actually hold life insurance. 47% of those Australians have enough to cover their basic needs, but 28% of those Australians have an amount to cover their standard of living. So what that's saying is the people that do hold life insurance, there's a very small amount that actually have the right amount to cover their standard of living or their lifestyle. Looking at some facts for income protection, which is covering up to 70% of your salary while you can't work temporarily. For Australians, only about 21% of their needs are being covered for that. So a lot of people don't have enough money coming in whilst they're ill or injured to cover their day-to-day. With regards to TPD or total permanent disability cover, so again, if you are sick and you're never able to work again, the average amount would only meet 14% of our needs. So for the period of their life where they need a bit of, covered expenses, they don't have enough. Most people don't have enough. You may or may not be aware that you already could possibly have life insurances inside your super fund being paid by your super. Looking at the facts we just went through, it's likely that you probably don't have enough life insurances. There are some things to be wary of. If you are getting towards age 40, around that mark, sometimes super funds start to reduce the amount of insurance after 40, and that means you may not have enough life insurance. That's your period you're usually paying down home loan debt. So that's something to be aware of as well. Is your insurances dropping? Do you have enough insurances? I wanted to give you guys a bit of an example. So I'd love if you'd play along, maybe have a look at your super, see what insurances you currently have inside that, and we can compare and kind of check it as we go along as well. So I've watched a lot of Simpsons growing up, so I've called this couple Homer and Marge. They're both 30. They're currently paying down a home loan debt and they've got about $400,000 remaining. Currently, their expenses are about $80,000 per year. They've had a look inside Homer's super fund, and the default insurances that he has at the moment is $300,000 for life and total permanent disability. So let's say Homer eats a donut and he isn't aware that it's actually come from nuclear waste. What would happen to Homer? That's pretty bad. Maybe he's in hospital for a while. He can't go to work. Maybe Marge stops work or isn't working to go care for him at the hospital. How do they kind of cover their expenses of $80,000 a year while Homer's in hospital? Well, maybe there's some medical expenses he has to cover as well, with maybe $20,000. So all up for the year, they've got to cover $100,000 of expenses while Homer isn't working. Well, in the short term, Homer doesn't have any income protection insurance. So while he's in hospital, not working temporarily, he doesn't have anything to cover his income. So if Homer is so bad from eating this nuclear waste donut, he can never work again, he would get a total permanent disability payout of $300,000. So his doctors have signed off and said Homer can never work again, he's not capable. So Homer would get paid out $300,000. He would also get to take out his super fund money. So this is a collection of, I guess, all of their money. He starts to take out that $100,000 a year. He needs to cover the whole family's expenses. And what happens about age 34 or after about 4 years, they don't have any more money to cover their expenses for the rest of their lives or their children's. So that $300,000 goes away quite quickly. I guess if you think about, $100,000 worth of expenses, that's about 3 years with a bit of super, maybe 3-4 years to cover their expenses. So that amount doesn't get Homer and Marge and the kids very far. So what if we up Homer's total permanent disability amount from $300,000 to $1 million? I think for myself in the past, and I think for a lot of people, $1 million sounds like a phenomenal amount. That should last us forever. But let's play it out and see how long it actually lasts for Homer and Marge. So they've got $1 million of funds to cover their expenses. What happens is that $100,000 per year that they need to cover all their expenses, like paying down their home loan, Homer's medical costs, it starts to go down until they reach about age 43, maybe 44. So that gets them a bit further than the $300,000 did, but not covering, I guess, their expenses in the long term. It's more short term. So what if we step it up and we say Homer's going to have $1 million of total permanent disability paid out to him. Of that $1 million, we're going to take about $400,000 of that and pay out completely his house or his home loan debt. So he doesn't need to pay the bank a lot of interest anymore. It's all paid out in full. And we'll get him some income protection insurance for a period of 5 years. So age 30, Homer's not taking anything out of that TPD amount. He's solely living on income protection for 5 years. So about 70% of his salary or his wage is getting paid to him. So what happens at age 35? That income protection stops. That's all been paid out to him, and now he goes back to relying on his TPD or total permanent disability payout, which, was about $600,000 after paying out his home loan. That's kind of accumulated over the 5 years. So he may have put this money in an investment. So it's kind of compounding and growing in that time. He has income protection. When he starts to take that out, you can see again, once we take out that $100,000 of expenses a year, it gets him a bit further, closer to his 50s, but it still doesn't cover them in the long term. So now we've played around with the numbers a bit. We've determined, let's get Homer about $700,000 of total permanent disability insurance. Of that, let's pay out the house. So that's $400,000 of that. Let's pay that out. And we'll have $300,000 left to cover his expenses in the long term. Now, you can kind of see that his money is lasting him a lot longer in this instance. That's because we've gotten him income protection until he's age 65. So what's happened is he's been paid out that total permanent disability lump sum. It's sitting in an investment, growing and compounding until he's 65, because he doesn't need to worry about using that total permanent disability lump sum because he's getting income protection, and that's covering his salary or his wage until he's 65. So that makes all the difference, because when he's 65, that money has compounded and grown to over $3 million. And once you start to take out that $100,000 of expenses a year, it takes them a while to diminish the funds, and it lasts them all the way until age 95, which is the average life expectancy for them. So that's great. So that's, I guess, the optimum insurance funds or types of insurances that we'd probably do for Homer and Marge. We'd give him income protection until he was 65, so it covers his 70% of his wage until he's 65, and you can see that he doesn't need a huge amount of total permanent disability anymore, and his home loan debt is fully paid out. So that reduces his expenses as well, not paying about $30,000 of repayments a year. So a combination of all those things makes the difference to Homer and Marge, and just kind of tailoring it to them to discover, I guess, what amounts would cover them financially so they don't need to worry if something were to happen to Homer. So let's use our example. What if Homer didn't get his insurances looked at? Well, he's in hospital. He doesn't have any income protection insurance, so he's not getting his salary or his wages covered in the short term. So I'm not sure what Homer and Marge would do in that instance. They don't have any savings, so they'd probably go into debt or try and get a loan off a friend or family member, or maybe even stay with family and get them to cover their way. Homer does have total permanent disability insurance of $300,000. So if he could never work again, he would get that paid out. As we saw, it doesn't last very long with his expenses of about $100,000 a year. You know, if you do quick math and maybe try this for yourself as well, check your insurance. He has $300,000 of TPD, divide that by his expenses per year of $100,000. That's a rough calc, gets him about 3 years covering his day-to-day expenses. So I'd love if you tried that for yourself actually to see where you guys would sit. But in that instance, you know, after 33, after 34 ages, I don't know what Homer and Marge would do. They'd have to rely on family and friends to get their way. Maybe they would apply for disability through Centrelink, but you know, that's not always guaranteed. And if they do get it, you know, we don't know how long that's going to last. Governments always bring in new legislation, so you never know. But I'd love if you thought about and did the rough calc for yourself to see what would happen in your instance and what you would do if you didn't have enough insurance. Do you have family to lean on? Can they cover your expenses forever? In the short term, you know, what would you do if you couldn't work tomorrow for the next year or next 5 years? A lot of people come in and they say, well, I'm single, I've got no debt, no family, why do I even need life insurances? Well, to be honest, you probably don't need any life insurance, which is, you know, if you were to pass away, you would get a lump sum to your family. It's probably the least one you need because, you know, you don't have any debt, so you're not leaving your family in the lurch. But it's horrible, but it's actually more expensive to live. So the total permanent disability, it covers your expenses from now until age 95, which is the average life expectancy. So if you were to become ill or disabled and could never work again, would you leave your family in the lurch, I guess, where you'd go stay with them for the rest of your life? They have to pay maybe your medical expenses. Do they have to fit out the house, you know, with all the things required, you know, maybe for a wheelchair? Maybe it's not that serious, you know, you've hurt your arm and can never work again, but they have to cover all your groceries, expenses, rent, all that stuff like that. Do you want to leave that all to your family, or would you want to get enough to cover you for the rest of your life if you could never work again? And income protection is a great one as well. So cover you, you know, if you can't work for the next year or next 5 years, that gives you some temporary relief financially. It covers up to 70% of your wage. So again, you're not leaning on family or friends to kind of cover your expenses. So, did you know that you can actually pay your life insurances through your super fund? So you don't actually need to sacrifice any cash flow. You don't need to pay anything out of hand. You can actually set these up so they come out of your super fund, and you could set it up so you're fully financially covered in any instance and not be out of pocket, which I think is a really great thing to have. You don't need these insurances forever. As you get older and maybe you reduce debt, maybe you don't need as much insurance cover. Maybe you can reduce the amount of total permanent disability insurance, or maybe you don't need income protection for, till age 65. Maybe you only need it for 5 years. So you can always keep reviewing and reduce insurance as you need. They don't need to be forever. There is no right or wrong amounts. I guess it's all about your understanding and what you have in your circumstances and what cover you do or don't have. So I don't want you to think you're covered and you're not. It's personalized to what you would like. Well, I hope that was informative and of value today. I really hope, my intent is that this gets you thinking about what would happen in a horrible instance and how you would cope financially. And I hope that you will have a look at your insurances and see how much you need. You can go through insurance brokers and financial advisors to kind of find you the best price for these insurances and give you an advice on what might be best tailored to you. But you can also just go to your super fund and get a quote for the amounts that you think you might need and implement that as well. There are some terms and conditions in super funds that you should be aware of, but that's kind of a quick way to kind of up your insurances if you want to. Yeah, but thank you all for listening today. I hope it was of value. I hope you learned something and that triggers you to think a bit more about your life insurances. Thanks everyone. Have a great day.